about it because this developing story is causing ripple effects throughout the markets. We're seeing it this morning. Archegos Capital Management is a family office that had amassed huge positions in media stocks and China internet names. When some of those positions moved against it, and we saw that happen last week. We can talk about that in a second, why that was. The firm was hit with huge margin calls, was forced to liquidate more than $20 billion in stocks. At the center of all of this is Bill Hwang. He's the founder of that firm, which was set up as a family office after his own was closed. He was a part of Tiger Asia. He's a protege, disciple, if you will, of Julian Robertson. In 2012, he pleaded guilty to wire fraud on behalf of Tiger Asia. Now, all of this seemed to unravel late in the week when Goldman Sachs, which for many years had refused to do business with Bill Hwang, by the way, because of those insider trading, not just allegations, but the guilty plea itself, pushed him to sell some of these stocks. He had been long and leveraged long in a very big way, especially when it came to stocks like Viacom and Baidu. Now, Viacom, as we saw last week, was hit hard. In part, we should say, it was hit hard because it issued that stock midweek, and frankly, I hate to say it, I think there wasn't enough appetite for that stock. So people always talk about when these stocks are high flying, should they sell stock, raise some cash? Well, that's what they tried to do, except that there really wasn't enough buyers. That, in turn, really put the short on. You guys talked about it and watched that last week. But as you could see, impacting this company and Bill Hwang's returns in a very big way, that creating a huge pressure downwards.
Yeah, we know why it was up. Andrew, we know why it was up so much now. And I wouldn't blame people for not wanting to buy the stock, knowing that it was up on it was almost a GameStop advance in those things. Did the guy really make $15 billion on $200 million? Andrew, did you hear that?
He was using we believe he was using total return swaps for most.
Once again, it's leverage.
Total return swaps. Yeah, it's all leverage. Something on the order of 3 to 4 or 5 times. We're going to talk a lot more. We have a couple guests coming up to talk about this. But just fascinating to see Goldman have to make this decision. And then what you're seeing in terms of getting really smacked around now, Credit Suisse and Nomura, which were the lenders in part of that leverage, they're getting hit in such a massive way this morning, saying they're going to both be experiencing significant losses resulting directly from transactions with what they're calling a U.S. client, that is Bill Hwang. So
this guy was everywhere. It's like a perfect storm because he was in all those Chinese internet stocks, too, and they're down for another reason. So all these things started happening. It's like the guy must have been like, what did I do? Because it was all dependent on various things, and they all went against it at the same time.
But it was also working for so long, right?
Yeah, right.
I mean, not so long, but
Muddy Waters.
That's the thing that's the craziest.
Yeah, that one stock, people don't even think it's. I mean, there's some questions about GSX from the start, and he had run that up as well. The whole thing is crazy. So there's a reason you have to say you own more than 10% of something, right? Because you can get in trouble. So if you use these things and nobody knows, here we are again with. I know what you're doing. Too big to fail, too. You're going to make it too big to fail, 2 or TOO. What have you decided?
Let's hope
these are swaps
squared.
Again.
Too big to fail squared with a little. But let's hope this isn't that. I know there's some people who think this is sort of a long-term capital style moment. I don't know if we're there yet, and
maybe
hopefully we're definitely not into it.
Maybe more Melvin capital style moment or something.
We can hope.
On a relative basis. It's probably why these margin calls were forced to begin with, right? Like, to prevent something like this from getting bigger. The answer was no mas. You can't do this anymore. Take a look, though, just at the 2-month. We just showed it a second ago. If you look at the 2-month chart of Viacom and Discovery, you talk about these incredible declines, more than 50% in a week or something. But over the course of 2 months, this is a chart we were just looking at a second ago, Viacom's only down 2%. Discovery's actually up 3.6%. So this was a huge run-up that came back really quickly. You're right to point it back to GameStop to say these are huge, huge moves that catch people on the top and on the bottom of these things. But going back 2 months, that's not much movement at all. So these are very recent, very rapid gains and losses.
Shepard Smith here. Thanks for watching CNBC on YouTube.